Hi, my name is Ujat and welcome to Rock with Option, a show for all your option needs. In our previous episodes, we spoke about how to use option strategies to generate a daily income. If you missed that series of episodes, do click on the link above. In those episodes, we spoke in detail about using option strategies to generate daily income. We also have spent time on talking about adjustments that can be used on those strategies to further enhance our outcomes. In this episode series, we're going to stick with that theme, the income generation. But here we're going to talk about weekly income generation. We're going to talk about how we can use calendar spreads to generate weekly income. In this episode, we're going to talk about what is a calendar spread, how do we execute a calendar spread, the entry, exit, and hold criteria, and the risk and reward. Let's get into the details. So before we get into the details, let us look at calendar spreads from a very high level perspective. A calendar spread involves buying far in time option and simultaneously selling closer in time option for the same strike price and the same underlying. In this case, we're going to either execute the strategy at the money or closer to at the money. What is the winning goal? In this case, theta is going to work in our theta decay is going to work in our favor. Also, we expect VIX volatility to increase, and that will significantly enhance our outcomes. What is a drawdown? It is the debit paid. Remember, we are buying far in time option whose premium is going to be significantly higher than the credit we got from selling a closer in time option. So the max drawdown or the max loss from this strategy is the debit that we paid for executing this strategy. This is a low margin strategy. We just need about 21-23K. So really works well with portfolios with small funds, small portfolios. And this again, like we've said, this strategy can be employed for generating weekly income. Now let's look at the entry, the setup for executing a call calendar spread. At the time of recording, Nifty was trading close to 16,600. So to execute a call calendar spread on Nifty, we would be buying far in time call option. So in this case, we would be buying a March end call option and then simultaneously selling near in time call option. In this case, we would be selling a 17th March weekly call options. Remember, the strike price for both options are the same, and the underlying in this case is Nifty. So what is the view of this setup? We have a very neutral view. When you're executing a calendar spread at the money or close to at the money, you have a neutral view on the market. You expect the market to be range bound. You also expect two Greeks or two parameters to work in your favor. One is theta, which is time decay. The other one is Vega, which is volatility. And since we are executing the strategy on Nifty, one can watch out for India VIX. Now let us look at how these two Greeks impacts the two options that we have considered. Theta decay. Near in time option is going to expire within a few days. So theta decay is rapid and is faster when compared to far in time option. So we hope that as we hold the strategy, theta works in our favor. Vega or volatility or India VIX when increases has a greater impact on far in time option than when compared to near in time option. So when we execute this strategy, we are expecting Vega to increase. When Vega increases or when volatility or VIX increases, our max profit considerably increases, our break-even points go wider, so our probability of making profit from the strategy increases. So there are two premises. We expect the market to be range bound. We also expect Vega to increase during the time of holding this particular strategy. Now, when do we execute a call calendar spread or when do we execute a put calendar spread? We always want our options to be out of the money, even at the expiry or even when we are holding this particular trade. The reason is when you're selling a weekly option, once you get close to expiry, 2 or 3 days before expiry, the margin requirements increases. in order to avoid that, we want our option trades to be out of the money. So although you have a neutral view on the market, if you expect the market to be mildly bearish, or the probability of market being in the bearish territory is high, you execute a call calendar spread. And you, inversely, if you expect the market to be mildly bullish, you execute a put calendar spread. Mechanisms, as we have spoken, is very simple. You kind of buy at the money, close to out of the money, a monthly or weekly call or put option, and simultaneously at the same strike price you sell a put or the call option to set up a calendar spread. So when do you enter a calendar spread? Like we have seen earlier, we want Vega to increase, and you want Vega to significantly impact or increase your probability of profit and increase your max profit. So you enter when there is low IV, when Vega or India VIX is low. So your IV percentile has to be less than 30 to 40%. That is the ideal time you enter this particular trade. The other time that you can consider is, different time options have different IV. So when your near time option IV is higher than far in time option IV, you enter this trade. So when your near in time option IV is higher, so since you're selling that particular option, you're collecting greater premium. And since far in time option IV is lower, so you're paying less premium to buy that option. And more or less, the IVs kind of catch up, it's mean reverting, so you kind of benefit from IV expansion. You also watch out for events that causes VIX to increase. Fed RBI policy, the Fed meetings leading up to that event, you will see the IV India VIX or volatility increase on Nifty. So you take advantage of these events and close the positions just before the event happens. Remember, after the event happens, there's usually an IV crush, so you ride that increase in VIX up till the event and close the trade before the event. The ideal time to enter this trade is Friday. Around 2 p.m. the market has settled. It's the start of new weekly option cycle. So it's an ideal time to enter into the trade. And the weekend, there is a huge theta decay that happens over the weekend, so that also works in your favor. So as we discussed earlier, max loss is the debit paid. You paid since you're buying an option which is far in time, so the premium is higher, and then selling a near in time call option, so the premium is lower. The difference in the premium or the debit that is paid is your max loss. However, the max gain and the break-even points is undefined, and it significantly changes with change in Vega, and we're going to see that very soon with a graphical representation. Probability of profit for this particular trade is around 55 to 60%, which is quite healthy. Now let's get into the details and look at the payoff charts. So we all know what is a payoff chart for both buying an option and selling an option. Here's a quick glance at it. The break-even point when you buy a call option is the strike price plus the premium that you have paid. So once the stock starts trading above the strike price plus the premium, you start making money. And below that, you're losing on this particular trade. When you sell a call option, you make money, or you're profitable as long as the stock remains below the strike price plus the premium. So the premium that you've collected, and below the strike price, you continue to stay profitable, and below that you start losing money. When you combine these two, remember both the options are at different timelines. So when you combine these two, you get a beautiful chart like this. As we said, it's range bound, so as long as Nifty is within the range, you are profitable on this particular trade. Your max loss is capped at the debit that you have paid. So this is a low risk, a low reward strategy, and a wonderful strategy for even first timers who are getting used to option trade strategies. Something that you can implement because your max loss is locked in, and it's a low risk and low reward trade. Now let's look at various scenarios and the outcomes of the same. So now let's look at the various scenarios and the outcomes, and the payoff chart. This is for a call calendar spread. So the payoff chart is not as beautiful as the one that we saw previously, but this is hand drawn. So do bear with me. This is done so that we can simulate the various scenarios and see what the outcomes are. Again, before we get into various scenarios, I again want to talk about, I want to kind of bring in the impact of theta and vega on the two options we have discussed in details earlier. I just want to bring it onto this slide so that we don't lose sight of it, because all the outcomes depends on the impact of these two Greeks, theta and vega, on the two options that we have considered. Scenario 1, stock or Nifty in this case remains range bound. VIX is constant, that is vega is constant, and obviously the longer you hold, the theta decay plays in your hand, and we have seen, as we have seen, the near in time option decays significantly faster than far in time option. So in this case, in all probability, the outcome is profit. You will start seeing profit on this particular trade. Scenario 2, the stock is range bound, the Nifty in this case is range bound. VIX increases, so volatility or vega increases. So when vega increase, if you see the new payoff chart is significantly taller and significantly wider. So when vega, or in this case India VIX, increases, the max profit increases considerably. Also the break-even point increases, goes wider. So our window for profit increases considerably. So again, when VIX increases, the outcome is that this particular strategy will yield a profit. Scenario 3, what the inverse is also true, right? If Nifty stays range bound, VIX decreases, so volatility decreases, vega decreases, so the inverse is true. So our window of profit decreases considerably. The max profit decreases, our break-even points is further reduced. So in this case, even if Nifty remains range bound, you still come out profitable. However, since the window has decreased, there are a greater chance that you would end up losing money on this particular trade when this happens. So again, our entry is very critical. You want to enter when IV or volatility is lower and you expect volatility to increase. Scenario 4, what if the stock runs away beyond this or goes out of range, right? When that happens, obviously, irrespective of what happens to VIX or theta decay, you will see a loss on the outcome. And the max loss, as we have discussed in our payoff charts, is the debit that you have paid to execute this strategy. So that is your max loss, and that is where the losses are capped at. So this is the 4 scenarios that can play out when you execute a calendar spread. So now that we've looked at the mechanisms, the setup, the entry, the various scenarios and the payoff, let us look at the exit criteria. We are going to exit this particular trade at 25% of the initial max profit. We have shown previously how vega has a considerable impact on the max profit. If vega increases, the max profit increases, and vega decreases after taking the trade, the max profit decreases. So for our exit criteria, we are going to consider the initial max profit that was available when we execute the trade. So as soon as we hit the 25% max profit criteria, we exit the trade. More often than not, we are not holding this trade till expiry. The reason being, like I said, we execute this trade on Friday, but Monday and Tuesday, if Nifty is range bound and if theta and vega works in our favor, we are able to exit the trade before the expiry. The other thing we have also seen is when Nifty swings considerably beyond the range, it has a negative impact on our outcomes. So if there are any news, any fundamental conditions that arise that would significantly impact the Nifty movement, do consider those movements and exit the trade earlier so that the negative impact is minimized. There are 3 adjustments that can be executed on this particular strategy, and we're going to look at those 3 adjustments in the next episodes. So stay tuned to that. Discussion on any option trade is not complete without discussing the risks involved. So let us look at what are the risks involved in a calendar spread. Remember, we are selling a near term, we are selling a weekly option to execute this calendar spread. So as we get closer to expiry, there are 2 risks involved. One, if the options move in the money, additional margin is required to hold on to this particular trade. 2, as we get closer to expiry, gamma risk comes into play. So a small change in Nifty has a significant impact on our M2M profits and losses. You will see our P&L swing significantly. However, if you have entered this particular trade keeping our entry checklist in mind, so we enter on Friday, by Monday and Tuesday, with minimum Vega expansion and with theta decay over the weekend playing in our favor, we should be able to exit by Monday and Tuesday with a decent P&L. However, if you have to hold on to this particular trade beyond Tuesday, both the additional margin and gamma risk comes into play. Third, this is an actively managed trade. There's a lot of thought process that goes into executing this trade. We have an entry checklist that has to be matched. Then there's a decision as to what strike price, whether it's a call calendar spread, put calendar spread. Again, for exit, there is an exit criteria. We have not spoken about adjustments in this episode, but when we get to that, you'll see that again there's a lot of thought process that goes into adjusting this particular trade. So this is an actively managed trade, and one has to be ready for that. The last thing is VIX and Vega contraction. We have shown in our payoff charts how when VIX and Vega increases after we have executed the trade, significantly improves our max profit, significantly improves our probability of profit. The reverse is true as well. So if VIX and Vega contracts after we have executed the trade, it reduces the window of our probability, reduces our probability of profit, and will have a negative impact on our P&L. These are the risks that one has to watch out for when executing a calendar spread. So in summary, a calendar spread is a great option strategy that can be executed to generate weekly income. But do pay attention to the entry criteria, which is very, very critical. You want to enter or execute this trade in low IV environment or low VIX, and you expect the VIX to increase when you're after executing this particular strategy. Again, 2 Greeks that you want to work in your favor is theta and Vega, and we've discussed in detail how that would play out. It's a low risk, low reward strategy, so our losses are limited. It is the debit that you have paid for executing the strategy, so you very well know what is the max loss on this particular strategy. Also, it's a low margin strategy, so this could be very effectively executed in smaller accounts. I hope you found this session very informative. In the next episode, we're going to talk about adjustments that can further enhance the outcomes of calendar spreads. So do subscribe to us and watch out for that video on adjustments that you can employ on a calendar spread. Till we see you next time, trade small, trade often, and more importantly, happy trading.